Hi everybody, the Singapore savings bond that will be issued in August had hit a high of average return of 3% per annum over a 10-year period, and is currently should be one of the best guaranteed return products in the market. And we are going to talk about this, and also we're going to talk about, is there any other alternative to Singapore savings bond? For the Singapore savings bond, the interest is based on step-up rate. For year 1, it is 2%, and year 2 is step up to 2.86%. At the year number 10 is 3.29%. But you average the return per year over the 10-year period, it is equivalent to 3%. It is the first time that Singapore savings bond, since it launched in 2015, has hit the 3% mark for the average return. Before we talk about how we can buy Singapore savings bond, let's look at the past history of Singapore savings bond. The first batch of Singapore savings bond was launched in October 2015, which at the time the issue is 1.2 billion, and the subscription rate is only 430 million. After that, the Singapore savings bond offer was being reduced, and it was never oversubscribed since it's launched in 2015 until 2018, when it started to be oversubscribed. Starting from 2018, where they issue 150 million and it started to be oversubscribed. Despite the government have started to increase the Singapore savings bond offer from 150 million in 2018 February to 350 million, they have been oversubscribed for across 1.5 year period from 2018 up to May 2019. And at the point of time, Singapore savings bond hovering an average of more than 2% return per year over a 10-year period. And after that, from June 2019 onwards, the oversubscription start to come down, and Singapore savings bond was constantly being undersubscribed. And you have the worst undersubscription rate happened in July 2020, where the government offered 150 million, but only 9.6 million was being taken up. And the market are not so keen on the Singapore savings bond due to the low interest rate environment. And this year, we know that interest rate has started to pick up, and Singapore savings bond interest rate has started to pick up again. And there's more and more interest on the Singapore savings bond, and the oversubscription have come back again. And it started to oversubscribe again from June this year, where despite the government have increased back to 350 million, it is still being oversubscribed, as the number of people applied is more than double of the amount that government offered. And then for the July, the maximum offer was increased to 600 million. But it was still being oversubscribed. And because of that, those that apply for Singapore savings bond, you may not able to get the full amount you apply for too much. For the June Singapore savings bond, you only being allocated 15,000. That means if you apply for 20,000, the most you'll get 15,000. That's the maximum you'll get. And for July, it is only 18,000, despite it have increased to 600,000. So for the month of August, the government have increased to 700 million. And what will be the subscription rate? This is something we will only know in the month of August when the result is out. I will expect it should be oversubscribed also. So the next question you may want to ask, how to buy Singapore savings bond? First, you need to have two things. One, you need to have a CDP account. Number two, you need to have an internet banking account, either with POSB, DBS, OCBC, or UOB. You can also use your SRS to invest in Singapore savings bond. The maximum amount you can invest in a Singapore savings bond is 200,000 per person, and the minimum investment amount is $500. The subscription is open on the first business day of every month, and it will close on the fourth last business day of the month. And do think that when you apply, there's always a $2 transaction fee, non-refundable fee you need to pay. So there is a cost in buying Singapore savings bond, which is $2, regardless of how much you apply for it. This is just an example of how you can do it. For example, using DBS internet banking, under the invest portion, you just need to look for apply for Singapore government securities, and from there you choose Singapore savings bond. Click on next, then there will this Singapore savings bond. This is the August Singapore savings bond is there for you to apply. You can see it's for cash or SRS only. You cannot use your CPF to invest in Singapore savings bond. even though the interest is higher than CPF currently, as most of the time the Singapore Savings Bond return is less than CPF 2.5% return. And after you submit your application, there'll be a service fee of $2. With the popularity of Singapore Savings Bond recently due to market downturn and due to interest rate rising, a lot of people prefer to park money into Singapore Savings Bond, and this has resulted in oversubscription in the past 2 issues for the month of June and July. So August, with even a higher interest rate, there's a high possibility that you'll be oversubscribed. You will apply for big quantity, you may not get the full amount. How does the Singapore Savings work? Is based on quantity ceiling. That means each applicant will receive at least $500 of Singapore Savings Bond. That means everyone is most like guaranteed getting a $500 of savings bond. After the amount will increase in a multiple of 500 for every applicant until an applicant have reached the full amount applied for it, or until all the available bonds have been allocated. So whichever comes first. So if the number of applicants is so large that the issue of 500 per applicant exceed the amount of bond available, then the bond will be only allocated among the applicant randomly, which will receive $500. So this means that actually, if you apply for a smaller amount, you will have a higher chance to get full allocation. If you apply for big amount, the probability of you getting full allocation will be lesser. And this is a bit different from you buy for IPO shares, where you apply for a big amount, you may get more shares compared to those that apply for a small amount. This is actually pretty evenly spread out among all participants. So regardless of how much you apply, then there's something called cut-off amount. For example, let's say the cut-off amount is 18,000, but there's still some surplus. So the some surplus, you allocate $500 randomly to some of the application that apply for more than 18,000. I mean, some will get 18,000, some will get 18,500. This is using the July Singapore Savings Bond as an example. This is the example of the result of the July Singapore Savings Bond. You can see that the amount allocated is only 600 million, but the amount applied is 1.3 billion. It is more than double. And thus, the quantity ceiling is up to only 18,000. But some of the applicant will get 18,500. But there will be a percentage of them, approximately about 16.79% of them will get 18,500. The majority will get 18,000 or lower. Some of you will ask, what happens when the bond is mature? So Singapore Savings Bond is a 10-year bond with a step-up interest rate. And they'll pay you interest every 6 months. And at the end of 10 years, where they give you a last interest payment, and of course, they'll return you the principal and back to your bank account if you're using a CDP to invest, or back to your SIS account if you use your SIS to invest. And there will be no $2 transaction fees when the bond matures. One thing I like about Singapore Savings Bond is when you want to redeem early, let's say that along the way, maybe 3 years later, you feel that you need the money and you want to do a redemption. Can it be done? Yes, it can be done. You just need to go and submit the withdrawal application online through the banks, internet banking, or SIS. You must go through the SIS operator and submit your application online. So the redemption period is open monthly. It's from the first business day of the month to the 4th last business day of the month. That means you can submit your redemption within this period. And after you submit, you'll get the money back on the 2nd business day of the following month. However, do take note, you need to redeem in a multiple of 500. Let's say you got $50,000 worth of Singapore Savings Bond. You don't need to redeem the full 50,000. You can say you can want to redeem 25,000 as long as it's in the multiple of 500s. But you need to bear a transaction fee of $2 for the withdrawals. The best part of Singapore Savings Bond is when you redeem early, you will still get paid on the interest. Unlike fixed deposit, where your fixed deposit haven't matured yet, you have to break it. And most of the time, you don't get back any interest. You don't get back the principal. But Singapore Savings Bond, they will refund you the principal and the accrued interest. For example, your Singapore Savings Bond interest is supposed to pay out in September, but this month you submit an early redemption. So first business day of August, they'll pay you back the money, the principal, plus the interest calculated until end of July. So this is one of the good part of Singapore Savings Bond. They give you the flexibility of early redemption, but the bad part is there's only one payout date per month. It cannot be anytime you need the money, you can straight away submit a withdrawal, you can immediately get the money back. You must always wait until the first business day of every month to take out your money. So with such an attractive interest rate, and whether for the month of September and October were the Singapore savings bond interest will continue to go up. That one we can't predict on that. I assume that the interest rate will stay high for the next few months or even longer. Thus, there will be a lot of interest on Singapore savings bond, and everyone is capped at 200,000 maximum. And also due to oversubscription, you may not get the full amount you want to apply for. So what are the alternatives you can look out for? And a lot of people will ask me, is there any alternative besides Singapore savings bond that's currently available in the market? So let's look at what are the alternatives available in the market. First, there is a Singapore government bonds and the T-bills, where you also can apply through the internet banking. You have the same criteria as Singapore savings bond. You must have a CDP account, and you must have an internet banking account with DBS, POSB, UOB, or OCBC. And the application procedure is the same as Singapore savings bond, but there is no $2 transaction fee you need to pay when you apply for the SGS bond or the T-bills. The T-bills actually is a short-term debt issued by the government, which will mature within 6 months to 1 year. And the SGS bond is mature from 2 years to 30 years. And sometimes now the government may expand into 50 years. You will see a 50 years bond issued by Singapore government. However, for the Singapore government and T-bills, application is based on 2 types. One is called competitive bid, and one is called non-competitive bid. Means that if you want to apply for Singapore government bonds, SGS bonds, or T-bill, you need to bid for the price. It's just like COE, where you need to bid for the price. And they will based on the cut-off yield of successful competitive bid submit at the auction. So it's by auction method. But for those that don't want to bid, you also can put in a non-competitive bid, means that you take whatever that is based on the cut-off yield. That means you'll have unknown returns until the result is out. And the coupon rate for the Singapore savings bond can be lower or can be higher based on the cut-off yield. If the Singapore SGS bond close below the par value, which is $100, that means your cut-off yield will be higher than the coupon yield of the bond issued by the government. But if the closing price, if the cut-off price is higher than $100, which is, that means you call it a premium, then the cut-off yield will be lower than the coupon of the bond. So this is one thing about Singapore savings bond. You can always go to MAS website to check on when they're going to issue the SGS bond. From this table, you can see there's 21st of July. There's a 6-month T-bill coming up, being offered. And there's also a 1-year T-bill coming up. And 27th of July, there's a 10-year SGS bond going to be issued. And with that day, when they open up, you can go in and submit your bid. And after that close, then you will know what is the outcome. And you want to know about futures issue of the SGS bond or T-bill, you just go to MAS website. They'll have a calendar to tell you that when will the next issue come out. For example, now we will know that there's a new SGS bond will come out for auction on the 27th of July, which is a 10-year bonds. And then on the 29th of August, there's another 5-year. And 28th of September, there's another 30 years SGS bond going to open up for auctions. And you can go inside to participate on it if you are keen on that as an alternative to Singapore savings bond. How to sell this SGS bond? You can sell it through the internet banking, through the banks, or you can sell it in the open market. Let's say you got a brokerage account, you can sell it through it. But one thing you need to take note that for Singapore SGS bond, it is very illiquid. Means that you want to sell it, there must be a buyer from it. That means you sell to the open market, you don't sell back to the Singapore government. It's very different from SSB, Singapore savings bond, where you sell back to the government, and government will return you the principal plus the accrued interest. But SGS bond is just like stocks. It will be traded in the open market after you get it ready. A lot of people buy this, it's just mainly hold to maturity. But you really need to cash it out. This is the extract from SGX. All these are the Singapore government bonds. Practically, you can see there is don't really have any transaction volumes in the market or very low transaction volume. And actually, there is no transaction done for the whole day on 12th of July. If you really want to let go of it, you may need to let go at a big discount. You look at the bid-ask spread, the gap is very big because there is no liquidity. So this is a setback of SGS bond. As most people buy it will hold to maturity. If you really need cash to cash it out, then you may need to sell it off at a price lower than the market. And next, what about bank deposit? So let's look at the current bank deposit. This table is taken from Straits Times. It's published on 10th of July. We can see that the highest fixed deposit rate now is from RHB, 24 months fixed deposit is 2.25%. This is still lower than the August issue of Singapore savings bond, where the average yield for 2 years is 2.46%. So Singapore savings bond actually have a better yield currently in the market. But will the bank fixed deposit rate, interest rate going to continue to go up? That one will be anyone's guesses. But with the current interest rate increasing environment, there's a possibility it may go higher. But one thing about fixed deposit rate is that you were to do an early redemption, most likely you will lose the interest you put in. Compared to Singapore savings bond, you will get the accrued interest on that. And what are the third alternative of Singapore savings bond? A product that also gives you capital guarantee one is called a short-term savings plan issued by the insurance company. And which you see is a 2-year or 3-year capital guaranteed return guaranteed savings plan. As of today, currently there are 2 insurance companies offering this product. You can go to our website, you can find the more information. And like for example, China Taiping, they got an iSafe, which is guaranteed 1.8% return per year over 3 years. This means that your money will need to be locked in for 3 years. At the end of 3 years, you will get 1.8% return per year. The bad part of this is that if you were to surrender the plan earlier, you will suffer capital loss. That means that you need to really hold the plan for 3 years. But this type of plan comes with the death benefits. If anything were to happen to you along the way, they pay out 5% more from the amount you put in to your family members. Another company that also currently have the 3-year endowment plan is Etica, who claim to be the highest guaranteed maturity return in town based on 12 of June data. You need to lock in your plan for 3 years and you will get 2.3% return per year. Of course, this also comes with the death benefit guarantee. Some of you are wondering, Singapore savings bond have the best guaranteed return already. Why should I look for fixed deposit or look for this type of insurance company plan? First is that Singapore savings bond, there is a cap of 200,000 maximum you can buy. Not per purchase, the total Singapore savings bond you can buy is 200,000. Let's say you have 150,000 of Singapore savings bond you bought in the past already. That means the maximum application in future, you can only put in 50,000. That is the cap. So for those that already hit the cap of 200,000, so you have to look for alternative. You want something that is guaranteed, that is safe. Then the bank fixed deposit and this insurance company 3-year lock-in plan will be the alternative for you. And also like for those that have not hit the 200,000 cap, and due to the high demand of Singapore savings bond, we can see the past 2 months, the allocation is only 15,000 and 80,000. Let's say you apply for 100,000, you may only get 15,000 or 18,000. And you still got a balance of 80 over 90,000 of money where you need to deploy somewhere. And thus a fixed deposit and this type of plan will be an alternative for you. That's all I have to share with you. And if you feel that this video has benefited you, do remember to like, share, and leave your comment below. And also do remember to subscribe and press the notification button so that you'll be notified on my next video. I shall see you in my next video. Bye-bye.